you are 4 times more likely to be murdered by a close relative than win the national lottery. Hello, my name is Gerald Ashley, and it's my great pleasure to talk to you today about my new book, Financial Speculation, Trading of Biases and Behaviour. I hope you will enjoy it, and I'm taking this opportunity to run through some of the points and interesting topics that are covered in the book. Well, what made me write this book, I think, was a deep interest in financial markets, and also to look at markets in really quite a simple way. I think a lot of people are frightened and worry that markets seem very sophisticated, and I was struck by the fact how simple financial markets are. In fact, I would use the phrase that they are simple to understand, but not necessarily easy to trade in. And I wanted to look at the sort of simple fundamental drivers that move the markets and write about that as a topic. I think the most important part of the book, or the most important message of the book, if you like, is to look at human behaviour. Human behaviour is central to the activity of financial markets. Financial markets are not just about data, charts, company results. They're about how the individuals and groups and investment companies react to the information that's in the marketplace, and equally how they react to the information that they think is in the marketplace. So in fact, financial markets appear to be a large hall of mirrors of information and disinformation. And I hope in this book I've explained a lot of the aspects surrounding that information game and how we as individuals and groups of investors react to it, and hopefully how we can profit from it. Key to our understanding and operating in financial markets is how we analyse them. Some people go for a very technical route, maybe looking at econometric data. A lot of people spend time looking at technical charts. Others say that really you don't need to worry about any of that. You just need to examine the crowd. What are the crowd doing? What are the crowd going to do next? My own sense is, in fact, it's a mixture of all of those things. What we find with analysis is that certain techniques come in and out of fashion. Charts have been particularly in favour since the development of personal computers, and economic data seems to go in and out of fashion as to where we are in the economic business cycle. On the psychological side of things, or on the human behaviour side of things, there's been a lot of development and research in the academic world, and some of this is now getting applied into actual investment decisions and the way investment groups look at the marketplace. These two camps are not necessarily rivals and not necessarily in conflict with one another. Like most things in life, it's about striking a balance and finding what are the right techniques for you as an investor. What do you find you're most comfortable with, and how you can use it to your own benefit. There is no right or wrong answer in financial markets. It's in many ways an unanswerable question. The issue is about how we can try and understand the overall market and its overall sentiment and direction. There is no precise answer, but I think we can fumble, if you like, towards a general understanding of sentiment of markets at different times in the cycle. One of the themes I've tried to draw out in this book is this idea about, is stock market investment really just speculation? Are all these guys on the stock market really just a bunch of gamblers? Well, I think the answer to that is no, because I think the labels of speculation and gambling and investment are very blurred and get very confused. One thing we can definitely say is that gambling is really different from speculation and investment. If we look at gambling on its own, it's really what one would call a negative sum game. You cannot win as a gambler. After all, banks will lend to people who want to own casinos, but will not lend to people who want to enter them. When we look at speculation and investment, we're really talking about risk appetite. What I might call a speculation, you might think of as an investment. Equally, investments or owning certain assets move up and down a scale of speculation and investment. What may start out as a very steady Eddie investment turns out to have been maybe a wild speculation. This has certainly been the case in some of the blow-ups recently in the credit markets. So these labels can actually confuse your thinking about understanding markets. Put gambling to one side. Buy a lottery ticket if you want to, but it would be better to own the lottery company. But when you're looking at speculating and investment, you're really talking about your own personal risk preferences. It's important to understand those and to stick to them, but don't be hung up by the labels. People sometimes ask me if financial markets have changed, whether they're different from 20 years ago, 30 years ago, or certainly say 100 years ago. I think the truthful answer to that is in parts. Certainly the instruments and the availability of what we can trade has changed a lot, even over the last 10 or 20 years. But what has not changed has been the basic human nature and human drive behind financial markets. What is it that causes booms and busts? Not all of it is down to human behaviour, but a large part of it is. One of the characters I mention in my book is Jesse Livermore, who was a famous speculator in Wall Street in the 1920s. He was famously short of the Dow Jones constituent stocks at the time of the 1929 crash, and as a result made a large amount of money. And he had a little quote that went along the lines of that Wall Street never changes. The people change, indeed the suckers change, the market prices and the information changes. But Wall Street itself doesn't, because human nature doesn't change. And so our market's different, the terminology has changed, there are differences in the way we trade because of taxation and regulation, but what drives the human impulse to buy and sell and borrow and lend is still there and always will be. I think some of the favourite things I have personally in the book are looking at past examples of what's happened in financial markets. It strikes me as really interesting that financial markets seem to go round and round the same sort of wheel or cycle of events. The names change, the events are always different, maybe the circumstances and the background is different, but the overall reaction of markets always seems to be the same. People talk about boom and bust, bubbles and crashes, and these cycles go around and around all the time. And I found it personally interesting to write about past examples of that, and I hope the reader will find them interesting as well. They should be quite instructive, actually. Hopefully, the main lesson that readers will take away from this book is to understand and to be aware of their own investment behaviour and people in the marketplace around them. There's been a lot of research, some of it quite academic, on this topic, and a lot of people in financial markets are vaguely aware that there is a human element to it. Hopefully in this book I have teased out the key and salient points regarding investment behaviour, and that I've conveyed these to the reader and he'll be able to profit from it. Finally, I hope I've covered the most important aspects of the topic that I have written about in my book. I hope you found this of interest, and that indeed you will find the book interesting. Financial speculation and markets and all the actors and people who are involved in it are a fascinating crowd, and it's watching and understanding that crowd that is the main message. So as I say, I hope you've enjoyed this short video and that you will enjoy the book.